Starting June 1st, Mainland Chinese, with 100,000 yuan in the bank. Be prepared, don't be shocked. The EU passed a resolution to limit Chinese companies from entering the medical equipment procurement market. The cancellation of the small package tax exemption, Temu's U.S. daily users dropped 50. Mainland gold institution collapses, involving over 2 billion yuan. The biggest crash in history is coming. BYD shares plunged 17% in a week after triggering an involutionary price war.
It's all covered in today's China Truths.
Starting June 1st, Mainland Chinese, with 100,000 yuan in the bank. Be prepared, don't be shocked. China's economy is sliding fast, and the banking sector is no longer the safe haven it once was. Starting from June 1st, anyone with more than 100,000 yuan in bank deposits must prepare for 3 major shocks. They are 1. Brace for stricter rules on large cash withdrawals. 2. Prepare for deposit interest rates to keep sinking. 3. Face the rising tide of bank bankruptcies. Preparation. 1. Brace for stricter rules on large cash withdrawals. On June 1st, sweeping changes take effect. The People's Bank of China and the China Banking and Insurance Regulatory Commission jointly released a notice demanding tighter control over large-amount cash withdrawals. From now on, withdrawing your own money won't be easy. Individuals must undergo tougher identity checks and clearly explain how they plan to use the funds. Whether it's for buying a house, a car, or renovating a home, proof is required. 3 big changes stand out. First, what used to require just a one-day appointment now demands at least 3 working days in advance. Second, you'll need to state the exact purpose of your withdrawal. Third, these controls are no longer temporary. They're the new normal. Preparation 2. Get ready for sinking deposit interest rates. Since 2024, China's state-owned banks have been slashing deposit interest rates, with smaller banks quickly following. A few years ago, a 1-year deposit gave you 2.25%. Now, it's down to 1.5%, and likely heading even lower. Your money in the bank is losing value faster than ever. Preparation. 3. Face the rising tide of bank bankruptcies. The risk is real. In recent years, more banks have gone under. Taizihei Village Bank and Liaoning Commercial Bank are just a few names on a growing list. In 2024 alone, 195 small and medium-sized banks have already dissolved. The old belief that your money is safe in the bank? It no longer holds. Depositors must now seriously prepare for the possibility of their bank going bankrupt. The EU passed a resolution to limit Chinese companies from entering the medical equipment procurement market. According to the Financial Times on Monday, June 2nd, the resolution passed by EU member states stipulates that public institutions across the EU must exclude Chinese manufacturers from bidding on contracts worth more than 5 million euros over the next 5 years. This marks the first time the EU has taken action under the International Procurement Instrument, IPI, in response to Beijing's discriminatory market practices in this sector. The European Union noted in January that Chinese policies compel domestic hospitals to choose local suppliers. The investigation found that 87% of tenders showed direct or indirect discrimination, including outright bans on imported medical equipment from participating. After the cancellation of the small package tax exemption, Temu's U.S. daily users dropped 58%. In May, the number of daily users on Temu, a global discount e-commerce platform under Pinduoduo Holdings, plunged 58%, according to market intelligence firm Sensor Tower. Under an executive order signed by former U.S. President Donald Trump, the U.S. government revoked the small package tax exemption. de minimis, referring to duty-free treatment for e-commerce packages valued under $800, for goods originating from China and Hong Kong, effective May 2nd. For years, Temu and Shein have relied on the de minimis policy to ship products directly from Chinese suppliers to American consumers, helping them maintain ultra-low prices. According to data collected by consulting firm Bain, since Trump announced comprehensive trade tariffs, both Temu and Shein have seen a sharp slowdown in sales and customer growth, though Temu has been hit harder than Shein. Well-known Mainland gold institution collapses, involving over 2 billion yuan. On June 1st, several mainland Chinese media outlets reported that Yuan Gold, a well-known gold service provider with more than 30 stores, experienced abnormal redemption issues and is now unable to process refunds or withdrawals. Many victims stated that Yuan had built trust through a decade of stable redemption. Some families invested as much as 20 million yuan, and even Yuan employees reportedly invested all their assets, with some going into debt to do so. Currently, the number of affected individuals exceeds 10,000, with losses totaling over 2 billion yuan. Many investors have not yet come forward, with conservative estimates suggesting losses could reach 5 billion yuan. Yuan promoted investment products with promised returns of 12% to 18%, claiming to have a state-owned background and bank custody to boost investor confidence. It also promised that if gold prices rose, investors could withdraw either physical gold or settlement income. If prices fell, the principal would be refunded along with an 8% annualized return. Points could also be exchanged for gold, luring large numbers of investors. American economist David Huang remarked, "This is a financial product disguised as gold. When gold prices surge and customers try to redeem physical gold, the platform reveals its true nature. There is no gold at all. It's a scam." The biggest crash in history is coming. Robert Kiyosaki, author of the bestseller Rich Dad, Poor Dad, issued a stark warning on X on June 2nd. He declared that the greatest financial crash in history, predicted in his other book, The Capitalist Manifesto, Prophecies of the Rich Dad, is now imminent. Don't say he didn't warn you. Kiyosaki fears the crash has already begun and will stretch into this summer. He warned that millions of people, especially baby boomers from his own generation, will lose everything as stock and bond markets collapse. But there's a silver lining. Millions who prepare in advance could become extraordinarily wealthy. Kiyosaki predicted that billions of dollars will pour into gold, silver, and Bitcoin this summer as markets tumble. He believes silver is currently the most undervalued and promising asset. In 2025, it could triple in price. Even better, silver is still 60% below its all-time high, unlike gold and Bitcoin, which are already at or near record highs. He said he's heading to his local bullion dealer tomorrow to trade in what he calls phantom assets for real silver, no ETFs. Kiyosaki noted that silver trades around $35 per ounce, meaning almost anyone in the world still has a shot to grow richer, while millions of others sink deeper into poverty. He urged people to act now and seize this once-in-a-lifetime opportunity to get rich. BYD shares plunged 17% in a week after triggering an involutionary price war. BYD Commercial shares tumbled, dropping more than 17% over the past week. Bloomberg reported on June 2nd that BYD had ignited a fierce price war that is sweeping through China's auto industry, squeezing profits and darkening the outlook for the entire sector. Although BYD's May sales hit a record 382,476 vehicles, its best monthly result in 2025, this represented just a 15% year-on-year increase, the smallest gain since August 2020. The price war has worsened the pressure in China's already cutthroat car market. BYD is slashing prices to maintain its lead as the country's economy falters and rivals gain ground. In April, Geely's compact hatchback, the Star Wish, overtook BYD's Seagull as the best-selling model in China. Meanwhile, smartphone giant Xiaomi is continuing its aggressive foray into the EV market.
China's May economic data not optimistic, experts, it's already a zombie economy. The National Bureau of Statistics of China recently released the national economic data for May, describing it as showing a trend toward improvement. However, experts analyze that the mainland economy has become a zombie economy. Between January and May, the total retail sales of consumer goods increased year-over-year, but at less than half the rate seen before the pandemic. Despite a reported 3.7% increase in May, which is higher than the previous month and marked the first rise since December last year, experts suggest the increase is not as promising as it appears. Senior Taiwanese political and economic scholar Wu Jialong attributes the rise to seasonal factors, indicating that holiday spending does not predict sustained consumer activity. Following the release of China's economic data for May by the National Bureau of Statistics, spokesperson Lu Aihua reported signs of recovery and improvement in the economy, with increased policy support and accelerated investments from the central budget and special bonds. However, Mr. Wang Guichen, a research assistant at the China Economic Research Institute, offered a starkly different view, describing mainland China's economy as a zombie economy. He explained that in a zombie economy, any movement or activity is solely driven by government intervention. When the government injects funds, the economy briefly reacts, but it stagnates as soon as the government pulls back. Zombie economics is characterized by a financially insecure and crisis-prone future, primarily caused by an imbalanced economic structure. Wang noted that the Manufacturing Purchasing Managers Index, PMI, remains unstable, hovering around 50. The PMI only improves when the government increases spending and declines when it does not. The economy, therefore, fluctuates based on government spending without sustainable momentum. Mr. Wang emphasized that these fluctuations are due to the government's direct involvement. Without such intervention, the economy would likely worsen, a reality the government might prefer to avoid disclosing. Additionally, economic scholar Wu Jialong mentioned that the manufacturing and investment sectors aren't doing too well, showing that there's a steady economic downturn going on, which is really tied to some deep-seated issues in China's economy. He also said that the government has pretty much tried everything they could think of to stop this economic slide, but nothing's really worked so far. Mr. Wu argued that the current government measures are more focused on maintaining stability and managing potential social unrest rather than genuinely rescuing the economy from its ongoing struggles. China leads the world in loss of wealthy individuals, severely impacting its economy. On June 18, the international investment immigration consulting firm Henley & Partners released the 2024 Henley Private Wealth Migration Report, detailing the latest net inflows and outflows of millionaires. The report estimates that 15,200 wealthy Chinese will leave in 2024, up from 13,800 in 2023, representing a record level of wealth outflow for China. Professor Xia Tian from the Aiken Business School at the University of South Carolina stated, "These wealthy individuals are leaving, capital is fleeing, and industrial chains are shifting. They are also joining the major shift in international industrial chains, with their own companies also fleeing, which represents a significant hemorrhage for the Chinese economy." The phenomenon of capital flight from China has existed for many years. In recent years, the Chinese government has strictly controlled the transfer of funds overseas, but in 2023, wealthy Chinese still transferred hundreds of billions of dollars out of the country. He explained that the ongoing migration of China's wealthy individuals is largely due to the CCP increased suppression of private and privately owned enterprises. Favoring state-owned enterprises, the CCP views private entrepreneurs and wealthy individuals with suspicion, often treating them as outsiders. This has led those who can to leave the country. The situation has been exacerbated by the imprisonment of several businessmen closely associated with the CCP, such as Xiao Jianhua, Wu Shaohui, and Ren Jiqiang, along with temporary disappearances or severe legal actions against other entrepreneurs like Jack Ma and Su Jiayin. These incidents have driven many wealthy Chinese to silently flee the country. Professor Xia highlights the growing challenges wealthy Chinese face in escaping the country, liquidating their assets, or converting them into foreign currency. This exodus is driven by a pessimistic view of China's declining economy and limited investment opportunities. Additionally, the threat of higher tariffs from Europe and the USA makes investing in China less appealing, as it limits the exportability of Chinese-made products. Consequently, many investors are relocating their capital and operations to avoid these tariffs. Popular destinations for these migrating millionaires include Singapore, the USA, Canada, and Japan, with Southeast Asia becoming a significant option. Many have relocated their family businesses to Singapore or moved their production to Vietnam to sidestep trade sanctions. Mr. Xia, a Malaysian Chinese businessman, noted that many of his business contacts have migrated, with some only realizing the necessity after the pandemic increased the financial burden of migration. He recounted advising his friends early on to consider moving abroad, but many were initially skeptical. The economic downturn post-pandemic and ongoing trade wars have since persuaded many to leave, leading to job losses and business closures within China. He said that many are now opting for decentralized virtual currencies to bypass national and banking restrictions, converting RMB into such currencies for easier liquidation abroad, free from the oversight of the People's Bank of China. Reflecting on the broader implications, Mr. Xie concluded that many wealthy Chinese have recognized the CCP's hostile stance towards them and are now doing everything possible to relocate themselves and their assets abroad, even if full escape is not possible. Multiple Chinese banks to suspend online interbank transfer services due to system maintenance. Several banks including China Everbright Bank, Industrial Bank, Ningbo Bank, and Harbin Bank have recently issued announcements regarding the suspension of certain services due to system maintenance of the People's Bank of China. The service suspension scheduled during the period from midnight to 6 o'clock on June 23. These banks will suspend services such as electronic channel interbank transfers for individuals during this period. On June 18, China Everbright Bank announced that the People's Bank of China will conduct a maintenance window from midnight to 6 o'clock on June 23, 2024, affecting the small payment system and the online payment interbank clearing system. This will cause a temporary halt in transactions during this period. Consequently, China Everbright Bank will suspend several services, including interbank remittances, interbank connectivity, and transactions related to commercial bills, both in corporate and private online and mobile banking. Services such as transfers to other bank accounts, signing interbank agreements, and real-time receipts from other banks will also be unavailable. Similarly, other banks like Ningbo Bank, Industrial Bank, and Harbin Bank have announced comparable suspensions for the same reasons, though the specific services affected vary. Ningbo Bank will also undergo a system upgrade later in June, impacting certain services further. Industrial Bank will suspend RMB interbank transfer services across multiple banking channels, though ATM services for interbank personal transfers under 50,000 yuan, about $6,900, will remain active. Harbin Bank will suspend its small payment and interbank clearing system operations, affecting related interbank transfer services. Regarding the reason for this service suspension, the banks have only stated system maintenance and have not disclosed further details on the direct cause of these decisions, though there is speculation that a system vulnerability may have been discovered.
Please share your thoughts in the comments section below. We will keep reporting on the COVID surge in China, so don't forget to subscribe to our channel and turn on the notification bell to get the latest videos. And thank you for tuning in.